Danny Kirsch, head of options, joins us at Piper Sandler. Good mind for the macro as well. So, Danny, are we on track here with this analysis? Is the market just down because it got way too expensive and frothy and out of line with some of these realities like rates and the dollar?
Yeah, I mean, I think that's playing out. I think also positioning is so long going into year end, and we're seeing this in futures positioning is as long as it's been in years. I mean, some of like the euphoria, although now it's switching to quantum names, but you're seeing crazy amount of calls relative to puts trading. It's just like I think it became very consensus to get this like Santa rally, and for good reason. It typically works. We do tend to rally between Christmas and New Year's, but everything speaks to us that positioning has gotten super long. Breadth has been terrible for 2 weeks, and the S&P keeps making highs.
Bingo.
The group in front of me mentioned if the Mag 7 sells off, the market sells off. 100% right. That's what's been keeping things afloat. I think Dow Jones is now down like 8 or 9 days in a row. It's the most since like the 1970s. IWM looks broken. Equal weighted S&P trades terribly every day.
How about that KRE?
Like everything outside of the KRE sort of breaking down. I mean, anything value has just been getting smoked. If you looked at energy stocks lately, they trade down every single day.
Where are you at on that one right now, on KRE? Because you traded KRE with us a couple ways several times, and you had some really good trades in KRE. So sorry to spring that on you, but
sure.
What do you think?
I think into next year, you're going to want to be long. You just on a dereg. But okay. For the rest of this year, anything crowded long, any consensus trade is clearly just getting unwound. And the last one, it looks like it's going to be this Mag 7 trade, which had been held up obviously through Tesla, through Amazon, through Google, breaking out to new highs, carrying the entire market, and basically hiding what has been sort of happening to most of the S&P, where stocks have been trading lower for 2 weeks, but you had the Mag 7 going up most days, with Tesla being the notable winner, up I think 100% since the election, and that had been carrying things. Whereas KRE is broken down; it's almost given back its entire post-election gain. I think next year, though, the outlook for regional banks is incredible, and this is probably a good buying opportunity. But this is like where you set up trades for March or June, where you're going to get this big deregulation sort of push, and you'll see a lot more M&A. Just overall, obviously, Lena Khan's leaving the FTC. That'll open up the M&A markets, and they won't be the M&A that we've seen in regional banks that are forced. These will be the smaller banks picking up. Mid-sized regional banks picking up smaller banks, and those type of accretive transactions that we didn't see the last 4 years. And my guess is that regional banks will act fairly well. And I think to some extent, this is kind of what you want to hear from Powell. The data's been strong. Inflation hasn't moderated like they expected. They increased their PCE target to 2.5 from 2.1 in September. And why wouldn't they be a little bit more hawkish? It makes sense. And if anything, I think I would expect like the long end maybe to come down a little bit because inflation might not be as out of control as it looked like it was going to get, especially if this was like a dovish Fed. This is kind of what you want to hear. And in the face of very, very long positioning, you'd expect a little bit of an unwind, which is what's happening.
Okay, last point on the value trade, and I'll use KRE as kind of a loose benchmark for that, because we talked right after the election when you were making that case for the deregulatory bullish side, and we're basically scratch on that right now. So the follow-up then is, these things seem very logically bullish, to your point. Acquisition potential in banks, deregulation in general, the message about the economy being strong. All these things are positive. But I wonder if the regulatory side and everything associated with Trump 2.0 is still a more speculative trade than inflation trends and relative U.S. versus rest of world strength, which is basically like yields up, dollar up, it seems like.
Yeah, I think that the near term is everyone is piling into the U.S., and you're seeing that clearly in the Dow. The other thing is, like, just think about what central banks have done recently. BOC cutting, I think, 50 bips last week. ECB cutting. SNB doing the surprise cut. BOJ not hiking and sort of being a little more moderate. Although, sorry, they're there tomorrow. I guess we'll see if they hike, but the expectation is to hike in January. So you have every other central bank is being very dovish or cutting. I mean, I guess Brazil did a surprise hike, but that's like seems to be a total disaster. Whereas the U.S., because the economy is stronger, is sort of forced to be a little bit more hawkish relative to everywhere else. And so, yeah, perhaps those trends could continue. To me, I wonder if this is a little bit of a market clearing event. You've gotten the hawkish Fed out of the way. Obviously, you're going to get positioning a lot cleaner after today when people are above their, beyond their skis long. Perhaps this is like a good setup for, I don't know necessarily think the rest of the year because liquidity is going to be sort of weak, and it's not like that necessarily the best time to put on positions. This is where you can speculate a little bit, and one of the speculative trades we actually like are buying some of the worst performing S&P names between Dec and Jan, because you get that tax loss selling benefit. So the names that have been tax loss selling losers, so stocks that keep getting sold, the names like Intel, for instance, it's down 50% here. We've actually done a decent sized back test of buying the 25 worst performing names in the S&P and owning them between Dec and Jan expiry. So Dec expiry is on Friday, Jan expiry is obviously in a month after that, and buying calls on these 25 worst performing names between Dec and Jan. Over the last 6 years, that basket has rallied 7% in that span on average, with only one down year, and that one down year being last year, but the first 2 weeks actually did quite well. So, perhaps there's a loser's trade or a mini rotation trade that's setting up as well between Dec and Jan expiry.
Do you have to do that stock specific, or are there any funds that do that well enough, or can I approximate if I just kind of go with one of those like value ETFs or something that's gotten beaten down? Are you talking about like deep losers on the year? Like I need to go like dogs of Dow thesis?
We look at the 25 worst performing single stocks in the S&P.
Oh, okay.
So
Got
it's
it. All right.
so the 25 worst performing names. So that's what we would stick with. Those names this year, a lot of healthcare and a lot of consumer staples. So you could look to those two areas, but I would say sort the S&P by the 25 worst performing names, and then pick a few of them for potential longs between Dec and Jan, and then the way we set it up, generally sell like an S&P call spread against it.
Got it. Okay, like that idea for stock-specific trades. Let's go into that S&P spread maybe and talk about one of our favorite subjects here, buzzwords, gamma. You're a gamma goon yourself a little bit, just like us, Danny. We love you for it. Tell me what you see right now. What kind of swinginess and how much is changing like from when you sent me this gamma
so
per 1% by strike?
Yeah, I looked before we sat down, and we still see the pin into year end around 60.55. 6,100 is shrinking a little bit. This is as of this morning. Obviously, the market's lower. We still see 60.55 the pin, and that level is interesting because that is a very large put spread collar that will be rolled on January 31st. I'm sorry, on December 31st. But that 60.55 level is kind of where we see, based on S&P positioning, based on option positioning, is where we see the market perhaps closing the year, which would be up, 100 points from, I think, where we are now. So, a little bit of a rally into year end potentially.
Okay.
Based on option positioning.
Okay. All right. So it sounds like you are more generally kind of in the camp that like this is probably a deviation from most of the trends. So then should I go back into to your point, either the dogs of the Dow kind of thing, go to the bottom 25, or if I look at the single stock stuff where where the real action has been, if S&Ps get volatile, will that detract at all from what people have been doing in companies like Tesla? Like if vol comes into the S&P and suddenly I can start doing some gamma trickiness there, then does that detract at all from the bull case for these big call squeezes that are pushing up some of these hot stocks?
Yeah, I think that's totally spot on. And Tesla specifically is like is almost like a market on its own. There is $8 billion now of AUM in levered ETFs tied to Tesla. So these ETFs, when Tesla goes up, they buy stock, and when Tesla goes down, they sell stock. So they can exacerbate movements up and down. Not to mention the insane call volume and put volume trading on the name. So there's just so much tied specifically to Tesla that I think to some extent it's feeding into over broader market volatility. This is just call volumes in Tesla. You could see near recent highs. I think the big spike was right around the election, but again, it's going up. And I think that there's just such a big momentum trade. But the way we've been playing Tesla, if you're long, great. Like, you can feel free to ride it. It's been an incredible trade, up 100%. But instead of hedging necessarily with Tesla options, which are very expensive and for good reason, we've been buying XLY puts. XLY is a discretionary ETF. It's up 25% since the election, and that's 50% of this ETF is Amazon and Tesla. So a quarter of it's Tesla, a quarter of it's Amazon, and the implied volatility is roughly 1/4 that of Tesla. So in lieu of buying very expensive puts on Tesla to hedge, perhaps look at an XLY. It hedges your Amazon exposure. So we've been buying puts on XLY to hedge this insane rally that Tesla's sort of seen, and perhaps, again, today down 6%. Because it's down so much today, there will be incremental selling based on these levered ETFs that, again, have ballooned in size that will cause more selling pressure into the end of day. So it's like anytime Tesla gets a move up, there'll be buying pressure. Anytime it gets a move down, there'll be selling pressure. Today, we're going to see that selling pressure, and we'll see how it manifests into the end of day. But you know that there is a non-discretionary seller of Tesla stock the rest of the day because it's down 6%.
Wow. Always a wealth of information, good ideas. I think there were like 3 or 4 trade ideas in there. We thank you very much, Danny. Appreciate your time.
Thank you very much. Appreciate it.